And in this edition of Search for Yields, I'm going to talk to you about how to study the new debt IPO that is to be launched on 14th of November, that is Monday. And the IPO, the issuer is CreditAccess Grameen Limited. It's a microfinance institution. Now, what is a debt IPO? A debt IPO is like an equity IPO, but it's an offering of bonds. Now, this issuer is issuing secured, redeemable, non-convertible debentures. Also, in terminology terms, we can call it bonds as well. And this IPO is like any other IPO where investors can invest in this IPO for as low as rupees 10,000. The face value of each bond is rupees 1,000, and the issue the bond has a maturity from 2 years, that is 24 months, to 5 years, and the effective return for investors investing in this IPO is ranging from just around 9.8% for 2-year maturity bond, and close to 10.5% for 5-year maturity bond. And the investors have a choice of monthly incomes or cumulative if they don't require. And these bonds will be listed on the stock exchanges and can be traded by investors, bought and sold by investors in the stock market or in the debt market as well. And platforms like INR bonds enable investors to invest in such IPOs and also access the secondary market liquidity for such bonds through the best of information. And here in this search for yields, I'm going to take you through what you should consider while studying, while looking to invest in this debt IPO. The first is that CreditAccess Grameen is a lender and lending to microfinance loans. And microfinance by nature is unsecured loans to a very large extent to the non-banking customers in typically non-tier 1 cities or even towns, tier 2 towns. They use a lot of technology as well as a lot of field force to give loans to such borrowers, and also make sure that the loans are well used and the borrowers are able to repay loans. Now, it's a well-established model in India, and microfinance lenders have been around for almost 15 plus years, and they have gone through ups and downs. They have gone through worse cycles, especially in the 2010 to 2015 period, when many big microfinance institutions had a very tough time. Many of them defaulted on loans, etc. But many good institutions, microfinance issuers, lenders have managed to survive and grow, and also learn from previous experiences. So the first is that obviously when investors look at a bond, they would compare what is a return, and the returns are pretty good for 9.8% for a 2-year bond, or close to 10.5% for a 5-year bond. If you compare it with any other asset class of such investment horizon, the returns are much higher, even from FDs. But however, since that returns are much higher, there is always a risk involved, and the risk here is that because the lender is lending to unsecured borrowers and unsecured loans, then the risk of the lender ability to service debt if these loans go bad increases. So that is a risk that investors are taking. But even more important, what should go into the investment? If investors like the returns and it suits the kind of maturity and the return profile they want for their investments, then they can actually then look at the company's ability to withstand any kind of stress. So the primary uh, factors investors need to look at for the company's ability to withstand stress is who are the promoters, who are the promoting groups, and in credit access, the promoters by a highly experienced team of professionals led by a highly experienced MD and CEO. And the promoting group is a multinational uh, institution and also other uh, institutions who have helped in promoting the company. So the promoters' credentials and the owners are also pretty good. But having said that, that really doesn't mean that if the company faces stress, they can always bail it out. They may not be in a position to do so. So the company should be managed well. So what are the main things to look at in a lender? So the main things to look at in a lender is what is the level. So the quality of the loans is given by this case. It's on a consolidated basis. It's the every over 3% of the gross loans are non-performing, and if more loans go bad, then this can increase. And in a situation where more loans go bad and this can increase, will the company be able to manage this stress environment? So that is coming through two areas. One is a capital adequacy, which is the amount of debt they can raise for the capital they have. And if the capital adequacy ratio, prescribed ratio is um, below 15%, but this company has a 25% capital adequacy ratio, and the higher the better. And as long as the company is able to stick to higher levels of capital adequacy ratio, and if there is a problem in their loan book, then if the ability of the promoters to infuse more capital is also should be considered. And in this case, the promoters, given multinational institutions, would be able to, in a reasonably uh, less stressful environment, could be able to infuse capital. But that doesn't mean that they will always infuse capital. The second is that also the importance of leverage, that is the amount of loans the company is taking against its equity to increase to grow their assets or to grow their lending. Here the leverage is over closer to three times, and which is reasonable. They are not growing too fast, and as long as they stick to a leverage of around below 4, then the company is on safer grounds. But the moment they try to go very high, then they're getting into more riskier territory. And all this is captured either both in in the bond market and in equity market. In the equity market, this company is listed and equity is trading, and the share price has done reasonably well. But more importantly, because it's listed, the amount of information that is available for bondholders is very high. Unfortunately, companies that are not does not have their equities listed, the bond holders have to depend on um, other sources of information for most information. Obviously, platforms like INR bonds provide you that information. But if the equity is listed, then investors can get all the information of the company at their on just through the uh, by any regular uh, online means. So net to net, this CreditAccess Grameen, on the credit the positive side, they have a strong promoter and parentage. They have good reasonably good asset quality. their levels of debt gearing is again reasonable, and they have a good capital adequacy ratio, and they have been able to grow their loans without uh, taking on too much of risk, extra risk on their books. And their ability to access liquidity in a stressed environment is pretty much okay, given that they are promoted by a group of a multinational, strong multinational parentage. Coming down to the risk factors, clearly, I think one of the biggest risk in microfinance is policy risk, because there is precedence that state governments have made sure that uh, the, uh, those who have taken microfinance loans can write off the loans without any recourse for the microfinance companies to get compensated for that. So policy risk is high. The second is that microfinance companies that grow too fast or try to dilute asset quality or lend to um, typically lend to borrowers who cannot repay just to show loan growth. All that is a risk factor, and it remains for the ability of the company and the management to make sure that they are pretty much well in line in how they go about lending. And the third is the where given that there is a geographical risk. So if it is all the loans are concentrated in one portfolio, where are these? Are these this safer place to lend? Are these uh, in this particular geography? Is the uh, nature of borrowers better than other geographies, or is it too much of concentration, etc., to one particular sector or segment of the borrowers? So these are the positives and negatives. So investors need to consider everything. Like INR bonds, we give you all the information, and you can take your decision to invest in Credit Grameen IPO. The issue is, if you download our app, QuickInvest by INR bonds, the issue is open for subscription on 14th. If you're all you need to do is for below 5 lakhs, just fill in details, a few details, and give a UPI mandate, and all your bids will be uploaded to the stock exchange, who will then keep contacting you for any for on the updates of your application. The money doesn't go out of your account till the allotment is made, and since it's just an UPI mandate, all you need to do is pay through your UPI. Very easy. You don't need to open any accounts, don't need to submit any documents. All you need to do is make sure that you have funds in your uh, to 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 pay on allotment, and it's all through the UPI. And you must have a Demat account to invest in this IPO. So 2-year bonds at 9.8%, 5-year bonds at 10%, 10 close to 10%, 10.5%. So comes with a bit higher level of risk, but is other risk well managed. That's with the information that INR bonds gives you. You should be able to take your own decision. And you can always reach out to us if you need extra support in terms of data. Thank you very much. And do download the app QuickInvest by INR bonds if you want to subscribe to the data IPO of Grameen Access.